What if I told you that one company, one you never voted for, one you may never have even noticed, quietly influences what you pay for groceries? How governments fight recessions, where your retirement money sleeps at night, and even what nations consider risky or safe. What if this company grew so vast that its decisions could sway global markets in seconds? Yet most people still believe it's just another investment firm. And what if the real story behind its rise isn't about greed or corruption or even brilliance, but something far stranger, a series of accidents, crises, and opportunities that allowed one private entity to become the unofficial operating system of the global financial world? Today, we're pulling back the curtain on a story with hidden origins, unseen leverage, and a mystery at its center. How did BlackRock, a firm founded in a small office with a folding table and borrowed computers, become the quiet power that so many governments now depend on? What happens when a company grows beyond the scale of any government's ability to supervise, regulate, or even fully understand? Stay with me. Because once you learn how this happened, you'll never look at the economy or your own financial future same way again. Montage of economic history in 1980s Wall Street, ringing phones, stock tickers. To understand how BlackRock rose, we have to start long before the company existed. We have to travel back to a time when the global financial system was expanding faster than anyone could track in, certainly faster than governments could regulate. The era of financial complexity from the late 1970s to the early 1990s, something dangerous was happening. Wall Street wasn't just creating new types of investments. It was creating entirely new ways of calculating risk. Derivatives, mortgage-backed securities, interest rate swaps, portfolio insurance. These were innovations meant to protect investors. But there was a catch. They were so complex that even the regulators didn't understand them fully. This complexity created a vacuum, a world where traditional institutions were suddenly too slow, too cautious, and too outdated to deal with the speed of modern finance. And it was inside this vacuum that a new kind of company could thrive. A company that specialized not in buying assets, but in understanding them better than anyone else. This sets the stage for a twist most people don't expect, because BlackRock didn't begin as a giant or a titan or a shadowy overlord of global markets. It began with one simple idea from one man, Larry Fink, who had made a catastrophic mistake that nearly ended his career. A mistake he swore would never happen again. And that vow would shape the future of global finance. The $100 million lesson in the mid-1980s. Larry Fink was a rising star at First Boston. He was brilliant, respected, and trusted with enormous portfolios. Then something went wrong. Terribly wrong. A miscalculation, one based on faulty risk assumptions, led to a loss of $100 million. It ended his trajectory at the firm. But instead of giving up, he became obsessed with one question. How do you build an investment firm that never gets blindsided by risk? Not sometimes, not usually, but never. This obsession with risk, both fearing it and mastering it, became the DNA of BlackRock. The birth of BlackRock 1988 with a small group of partners. Fink launched a firm inside Blackstone's office space. No one knew it yet. But the partnership between Blackstone and BlackRock would fracture and split, would define the future of both firms. BlackRock's early pitch was simple but revolutionary. We don't just manage money. We measure risks scientifically, precisely, relentlessly. This was the first major cause and effect moment in the story. Because markets were becoming more complex, clients desperately needed someone who could make sense of the chaos. BlackRock stepped into that need, and BlackRock's first truly powerful invention would change everything. The quiet birth of a global economic operating system, while other firms were hiring traders and opening new branches. BlackRock invested in something else entirely. Software. Deep inside BlackRock's offices, engineers built a system that didn't look like much at first. They called it Aladdin Asset Liability Debt and Derivative Investment Network. Not a catchy name, not a dramatic brand, but Aladdin became the most important financial technology platform on earth. Here's why. Aladdin does not just analyze risk. Aladdin simulates entire financial universes. It can calculate what happens to trillions of dollars under different interest rates, recession scenarios, political events, market crashes, or natural disasters. It tracks individual portfolios down to individual mortgages, and then models how each one responds to real-world events. In short, Aladdin became a crystal ball for global finance. And here's the twist. BlackRock didn't keep Aladdin to itself. It sold access to banks, pension funds, insurance companies, hedge funds, and even government institutions. By the early 2000s, trillions of dollars across the world were being managed using Aladdin. This created the second major cause and effect moment. Asterisk. The more firms used Aladdin, the more they depended on BlackRock, and BlackRock became effectively a contractor with powers no private firm had ever held. The US government wasn't just trusting them with advice, it was letting them manage parts of the crisis itself. This was the third major cause and effect milestone. Asterisk, as governments outsourced risk management, they unknowingly outsourced control. Asterisk, and it didn't stop with the United States. In the years following the crisis, Japan hired central banks hired BlackRock. Emerging nations hired BlackRock. By the mid-2010s, BlackRock had become the world's largest asset manager, not just because it invested money, but because entire governments depended on its expertise. This dependency created a new kind of power, a power with no political boundaries, new electorate, and no rival capable of replacing it. The fallout, consolidation, influence, and unintended consequences from manager to kingmaker as BlackRock's assets under management crossed $5 trillion, then $7 trillion, then $9 trillion. A new problem emerged. Scale. BlackRock was becoming too big to fail, too big to regulate, and too embedded to... When a firm tracks risk for dozens of major banks, manages retirement accounts for millions, oversees investment flows for governments, and runs simulations that determine how trillions move, any regulator attempting to restrict that firm risks destabilizing the entire global system. This is the fourth major cause and effect transition in the story. Asterisk, the more BlackRock stabilized the world, the less the world could function without it. Asterisk, and then came a second crisis. A second breaking point, the pandemic acceleration. When the pandemic hit in 2020, global markets collapsed in weeks. Again, central banks faced the same dilemma they had in 2008, but this time, the scale was even larger. And once again, they called The Federal Reserve hired BlackRock to administer emergency bond buying programs, including ETFs, some of which were managed by BlackRock itself. This created unprecedented questions. How do you avoid conflicts when the firm running the program benefits from the program? How do you regulate a company that now helps execute the regulator's policy? And if governments rely on one firm in every crisis, does that firm become a de facto part of the state? BlackRock insisted it operated under strict rules, but the bigger truth was clearer. The modern global financial system had evolved in a way that made BlackRock indispensable. This was not a conspiracy, not a plot, not a secret takeover. It was something more unsettling, an emergent dependency, the natural outcome of governments outsourcing their most complex financial functions for decades. Failed fixes. Why nitrogen monoxide 1 has been able to limit BlackRock regulators tried. They failed in the 2010s. Some U.S. regulators considered labeling BlackRock a systemically important financial institution. This label would have subjected the firm to strict oversight. BlackRock argued that it didn't pose systemic risk because it didn't use excessive leverage. It wasn't a bank, and it managed assets rather than owning them. The effort fizzled not because BlackRock manipulated regulators, but because regulators could not agree on how to supervise a company whose power came not from ownership, but from scale, dependencies, and information. Meanwhile, Aladdin kept growing. Its weight in the global system kept increasing, and governments faced a painful irony. You cannot regulate the company that helps you navigate your own regulations. This is the fifth major cause and effect shift. Asterisk, the more governments relied on the harder it became to control it. Asterisk, asterisk, even when lawmakers tried to target index fund concentration, ESG voting power, or ETF influence, their efforts barely scratched the surface. Because BlackRock wasn't simply an investor anymore. It had become the nervous system of global markets. Modern parallels, shocking data, and repeating patterns. Here's where things get even more unsettling. Let's zoom out. Concentration of assets, BlackRock, Vanguard, and State Street collectively own significant stakes in the majority of US public companies. Most major European corporations, key firms across Asia, and critical global infrastructure. This isn't because they're villains. It's because they manage retirement funds, pensions, and ETFs that track entire markets. But the effect is undeniable. A small number of firms can influence votes in companies that shape the economy. Aladdin's expanding empire. Aladdin is estimated to oversee or model risk for $20, $25 plus trillion in assets globally. This means a single software platform influences decisions across thousands of institutions simultaneously. If Aladdin flagged a massive risk tomorrow, if it shifted asset allocations in unison, the ripple effects could be global. Governments outsourcing power, every financial crisis strengthens BlackRock further. This is the repeating loop. Crisis hits. Governments panic, BlackRock stabilizes, BlackRock becomes more essential. Governments become even more dependent. It is not a conspiracy. It's a feedback loop. A loop we have seen in 2008. The Eurozone crisis, Japan stagnation 2020, pandemic 2023, banking instability, and each time BlackRock's influence grows. So, what does this mean? The three big takeaways, asterisk, asterisk, BlackRock's power is systemic, not intentional. Its influence didn't grow because of a plot. It grew because the financial system became too complex for public institutions to manage alone. Dependency creates invisible influence. BlackRock doesn't need to control governments. Governments rely on it by necessity. That reliance gives it indirect power equivalent to that of a nation. The next crisis will make BlackRock even more essential. Unless something changes, every future emergency will increase the firm's centrality, strengthening the cycle we've seen for 2 decades. An open question for the future BlackRock is not a villain, nor is it a savior. It is something new, something our financial system wasn't designed to handle, a private company that has become a critical global utility. We have utilities for electricity, for water, for communications, but we have never had a global utility for financial stability itself. The real question isn't whether BlackRock is too powerful today. The real question is, what happens when the world's most indispensable financial institution faces a crisis of its own? Who stabilizes the stabilizer? Who manages the manager? And who will governments call when the company they rely on is part of the problem? That mystery is still unsolved. And the next decade may be the one that forces us to confront it. Closing call to action. If you found this story eye-opening and want to dive deeper into the hidden mechanics of global finance, the power is shaping your future in ways you've never been told. Make sure to like the video, subscribe, and hit the notification bell.